As of March 2026, the tech sector is in the midst of a tactical rotation. Investors are grappling with massive AI infrastructure costs, which have created pockets of Wall Street fatigue across high capex names. Even with short-term pressure, some of these companies maintain strong long-term fundamentals. Today, we're focusing on three key players to understand what's driving the recent moves and what bulls and bears are watching closely. Let's start with Amazon. In February 2026, the company stunned investors with a $200 billion capital expenditure plan aimed at cementing its dominance in AI and satellite infrastructure. The announcement sent shares down roughly 12%, marking a bear market-like dip of 18 to 23% below its recent all-time high. The bull case centers on AWS reacceleration. Cloud demand is surging due to AI workloads, and backlogs are reportedly 40% above revenue growth. Analysts at Wells Fargo and Oppenheimer see this massive spending as a moat-building exercise, maintaining price targets as high as $300. However, the bear case raises caution. Such enormous spending is expected to push free cash flow into negative territory this year, a sharp contrast to Amazon's historically robust cash generation. On top of that, ongoing FTC trials and potential consumer weakness in a softer economy remain key risks. With Amazon's infrastructure push setting the stage, we now shift from cloud dominance to AI-driven social and advertising platforms, turning to Meta. Meta Platforms is preparing for the launch of Llama 4, its next-generation AI model designed to compete directly with Google and OpenAI. The company is also expanding its use of Blackwell and MTIA chips, reducing dependence on external suppliers while increasing efficiency for AI workloads. Bulls highlight strong monetization gains. Meta's Lattice AI architecture has improved ad conversions by about 3%, showing clear ROI from AI investment. Analysts at Rothschild & Co. Redburn see Meta as undervalued with a $900 price target, arguing it trades at a discount relative to its long-term revenue engine. Yet the bear case warns of capital expenditure fatigue. Shares sold off 17% recently after Meta raised its 2025 to 2026 capital expenditure guidance to over $70 billion, sparking investor concerns about diminishing returns. On top of that, increased competition from ad tech specialists could pressure revenue growth if user engagement in core apps starts to plateau. From the social and ad tech frontier, we move to cybersecurity, where Palo Alto Networks is navigating a bold pivot. Palo Alto Networks has been aggressively transitioning customers to its unified platform, and while it recently beat earnings estimates, the stock experienced a classic sell the news reaction. The company also completed strategic acquisitions, spending $2.3 billion on CyberArk and $2.6 billion on Chronosphere to expand its cybersecurity ecosystem. The bull case emphasizes consolidation leadership. As companies aim to reduce tool sprawl, Palo Alto's integrated AI layer positions it as a dominant player. Wells Fargo recently initiated coverage with an overweight rating and a 43% upside forecast, noting that institutional buyers are returning at these lower levels. The bear case, however, points to integration risk. Management lowered its 2026 profit forecast due to the costs and challenges of merging these large acquisitions. Valuation volatility is another concern, as the stock has declined significantly from its peak, while the market recalibrates expectations for growth during this transition period. All in all, three high capex tech leaders navigating a market in flux. Amazon is investing massively in cloud and satellites. Meta is monetizing AI while managing heavy capital expenditure, and Palo Alto Networks is consolidating its cybersecurity platform amid integration challenges. Each has unique long-term potential, but short-term rotations are creating opportunities and risks for investors to watch closely in 2026.